And what you're seeing over here is one of the first wind turbines that we've put up at Agnew, a mine where we're going to have average renewable input into our energy usage of about 57%. So that's been taken by a drone, and good to see we've got the Goldfields logo on there in the middle of the outback, about 1,100 kilometres from Perth. But that shows you an indication of our seriousness to actually have an impact on climate change. And you know what? It's good business. It actually will be cheaper in the long run to power more of our mines with renewables than it will be with conventional energy sources. It has been an eventful period for Goldfields, and as recently as last night, we've been pretty busy, as some of you by now will know. We've been working very hard on getting the Salares Norte project to a decision point with our board. One of the key lead items behind that was to get the environmental impact assessment approved. That is ordinarily about a 2-year process. We were very fortunate that we got that ahead of time. A week before Christmas, I got the good news from the team in Chile that we'd secured that approval. And we thought we should move forward as quickly as we can. Now, we'd always slated to start the project in 2020, but probably press the button a bit later than what we're doing now. And given the fact that we've got that approval, that really is the umbrella approval for the project. So getting this approval means that all of these subsidiary approvals, and there are many, mining, closure, etc., are essentially in place. It's just a process now to actually procure the paperwork. And we're well advanced with that. And I'm hoping that certainly by the middle of the year or third quarter, we would have procured all, if not most, of the key permits. So that meant that we should update the feasibility study that we did a year ago. And given the fact that we've done more of the detailed engineering design than what we had a year ago, we're up to around about 60% today, which is unheard of for a project that you haven't even started building if you talk to the project experts in the industry. We felt that it was a good time for us to go. So we updated our numbers. You'll recall when we did the webinar when I was down in Peru in April, we were talking about an $834 million project. That was in money terms of about 14 months ago. We've updated those numbers because, of course, when you get more detailed engineering resolution, you will pick up certain items that will come in. Now we're talking about a project of $860 million in 2020 money terms. As you can see, hasn't really changed that much. We're still talking about around about 4 million ounces over life. That's gold equivalent. We're talking about $552 an ounce, all-in sustaining costs, a 2.3-year payback at a gold price of $1,300 gold, $17.50 silver. So a very, very robust project. And I mean, if you compare this to what's out there, if you look at the current cost curve for the gold industry, and if you look at it faithfully and truthfully, you'll find that the current cost curve is probably about double, if you include everything that should be included, of what this project is going to be. So that gives you an idea of how competitive this project will be in a country that has a proud mining focus, a proud mining history. Mining makes up around 13% of GDP in Chile. It makes up about 52% of total export earnings. So it's a key input into the economy. And we've had a lot of strong support for this project at both a national and regional level, and also from communities in the nearby towns around us. So we think we're good to go. So the board has approved the project, that we can start the project. And given that we've been looking at funding sources on this project for some time, that's no secret to you. I've been saying that now for the last 6 months. We did a fairly exhaustive process looking at all different sources of funding, including potentially partners. And at the end of the day, given the strong financial performance of last year, where we knocked off a lot of cash, a lot of debt, with the strong cash flow generation, around about $300 million came off. Paul and I thought we weren't going to have any reduction. Given the fact that our projects have come through strongly, Korea in particular, given the current gold price and the prospects for the company, we were more confident to take on a greater piece of this project ourselves. In addition, we felt that a judicious equity raise of our 5% pre-approval, which would contribute around about 30% of the total expenditure, was a good way for us to ensure that we could actually get a funding plan in place that we could put to bed and not worry about. Even if gold prices came down, even if there was a couple of wobbles elsewhere in the group, we could fund this project. And at the same time, we could sustain ongoing expenditure on the existing mines. We could continue paying a dividend, and we could make sure that the team wouldn't have to worry over the 33 months we expect this project to be built. So as you would have seen, we did an equity raise last night, which was completed in a couple of hours. It was oversubscribed. We got a lot more demand in than what we needed. So I think it was a strong message of support from our shareholders. The other good thing is between 80 and 85% of this raising went to shareholders. So we wanted to obviously focus on the shareholders who are on the register right now. The pricing was pretty tight. If you look at the pricing, it's about a 3% discount to the closing price on the day yesterday. 90 Rand 20 was the price. And if you look at a longer run, 30-day VWAP, it's about a 3.8% discount to 30-day VWAP. So very, very tightly priced, very competitive, and we're delighted. So that's given us around about $250 million that will provide about 30% of the capital for the project. And we can get going now on the early works. And the early works this year will be expanding the camp. We need to provide more beds, particularly during the construction phase, starting some of the early works, in particular diversion channels around the footprint. That's an important key input to ensure that we can start then putting all the foundations down for the plant, waste storage facilities, etc., and all of the ancillary equipment that we use, and then putting in some of the long lead items, ordering some of that equipment. And good to know that we've actually already pre-ordered a lot of stuff that we need. It was just subject to final approval. So we'll lock down those prices. We'll also lock down the mining contract price as well that will start at the end of the year. So I think there's a good resolution on the project. We think that we've got a good contingency as well in place, both in terms of time and in terms of amounts that could be spent over and above. And 67% of the money is going to be spent in local currency. And there's a cushion in there as well if you look at the rate we're using today of 700 Chilean pesos in the project versus the current spot price, which is close to 800. So that gives us potentially additional cushion. We've had another really good year at Gold Fields. The thing that makes us proud is the fact that over the last 7 years, we've essentially made our guidance in terms of production. We've done it at the right cost. We've been there or thereabouts. And in fact, over this last year, we produced more than what we said we were going to do. We actually went above the upper end. So there's been tremendous performances in every region. I'm not going to go through all of the details of every mine, but every mine has produced cash. It's hard to understand when we could last say that every mine in the group, 9 out of 9, has made cash flow for the last year. But that's what we've been able to do. Sure, we benefited from the higher gold price, but as I always say to the team, let's make sure we actually deliver the higher gold price to the bottom line. And we'll talk more about these results a bit later on. As you know, we've been in an inward investing phase over the last 3 years. We've been somewhat counterintuitive at a time when other companies were being pressurized in our industry to reduce costs. We've been investing for the future. Why have we been investing? We've been wanting to bring in new ore bodies that will provide longevity to the company at lower cost. In that way, we can create a portfolio that will be more robust to ever-changing prices, exchange rates, and cost inputs. We've built 2 new mines. Gruyere we brought into production in June of last year, and happy to say that we've essentially hit steady state mill output of 8.2 million tons a year annualized by the 4th quarter. And really the production we were getting was much in line with what we expected. Often with these new projects, You do a lot of work on understanding the ore body, understanding the costs, what it's going to look like. And then, when you actually start the mine, you take another deep breath to make sure that it's going to hit the numbers. And it's hitting the numbers, even though it's very early days. We're getting the grade, we're getting the volume output, and we're getting it at the right cost. So I think we're very optimistic that we brought Gruyere into production at the right time. On Damang, we're still in the process of getting to what I'd call the heart of the ore body, which is what we call the phyllite. That's the sort of rock type that we should be into by the middle of the year. Now, we've mined that before. We know it's nice big blocks, very consistent, easier to mine because you have less dilution, less ore losses. That's the stuff we've mined before, so we should be in the heart of that by the middle of this year. And then I think we'll see Damang take a real step up from where it is. But good to see that it moved from cash negative to cash positive as the project spend has come off. I've talked about Salares. Good to see that we made cash flow from the operations, $249 million after all of that capital expenditure we've just spoken about. And we also sold a whole bunch of non-core investments, Gold Road, Mavericks, and also Red 5, and generated some good money, which we felt was important to redeploy that money into the balance sheet, create the flexibility. And by the end of the year, we'd knocked off about $350 million off the debt. Now, Paul and I at the beginning of the year thought that we were going to be pretty flat on debt. So again, this has given us more encouragement to move ahead on Salares on our own. And the net debt to EBITDA ratio, as you'll see, is just marginally above 1 times. So that's, again, beyond our expectations. We have a dividend policy, which we like to honor over the years, between 25 and 35%. The average over the last 5 years has been about 30%. So we're pretty much in the range there. So a final dividend of R1 per share. For shareholders in the room, I'm one. Enjoy the money. And that means that for the year, we've given you R60. So who knows? If things continue on the current trajectory, maybe we'll even do a little bit better than that in the year to come. We have taken out some tactical hedges to protect the balance sheet. Pleased to say that going into this year, we have some hedges in Australia that will actually give us protection, and at the same time let us participate up to just under 2,000 Aussie dollars. In Ghana, we've got some hedges again on 50% production that will let us participate up to 1,460 US. And at South Deep, on 75% of our production, we've got a hedge at 704,000 Rand a kilogram. This will ensure that we can underwrite a meaningful debt reduction this year. We're looking for about $300 to $400 million. And given the fact that the bulk of the Salares expenditure really only happens from 2021, out of that $860 million, there's probably about $100 million that takes place this year, $110 million maybe, about $500 million next year, and about $250 in 2022. The fact that we're able to generate substantial cash in 2020 will put us in a good position for when we get into the really big spend on Salares Norte. A lot of people have asked us about M&A. There's been some consolidation in the industry. Are we going to be part of the consolidation game? I think it's fair to say that consolidation in our industry has been driven more by survival than it is by 1 + 1 = 3. And we certainly don't need to adopt those kind of tactics. We prefer to be in charge of our own destiny. We prefer to drive organic growth. Every one of our assets in this group has got organic growth potential. And one thing I've learned in this business over the years is that the best place to find gold is where you're mining it. And usually the risks are lower and the costs are lower than going into new operations where possibly the vendor has not been spending the money on the asset that it should have done. That's one of the big sins in our industry, and that's a sin that we certainly haven't committed, and we don't want to commit that going forward. With Salares coming in, notionally, people have also asked where would we be, and we're very confident that about a 2 to 2.5 million ounce a year profile for at least the next 10 years is a good number to look at, and there's upside both in terms of that number of production and in terms of life from there. South Deep has had a tremendous turnaround. We have gone way beyond our guidance and our expectations for the year. We've returned it to cash positive. And if you just look at quarter four we made 300 million rand. That's close to $20 million in quarter four. That gives you an idea, with the right focus, with the right discipline, what can be achieved. And there was never a question of the ore body not being here. And when you mine this operation with the right volume, you mine it spatially correctly, you get the grade. You can rely on the fact this is a 5.5, maybe 5.75 gram per ton ore body over the next 5 years. But long life, let's not forget the reserve grade's 5.5. So the key here is let's get the volume. How do we get the volume? Let's get stoping. Stoping is where you get the volume. That means you've got to de-stress, you've got to develop, you open up the cuts, and you get in there and you start stoping into these big cavities. And we're getting much better at mining these big cavities. Our resolution between compliance to plan and the plan is improving significantly. We were just talking the other day, some of the stopes now are getting very close to 100%. That was unheard of a couple of years ago. We've got some hedges in place which will underwrite this year as well. So at the guidance of about 8 tonnes for 2020, we got a 700,000 Rand hedge price on 75% of the production. Costs are 625,000 Rand a kilo. So we sort of arbitraged, if you want to put it that way, 75,000 Rand a kilogram on 75% of the production. So I think we're going to be making money here in 2020. You can remind me about that promise at the end of the year. All right, so that's it. I mean, these are all indications. We talk about gold and cost. These are the things that happen behind it. So there's some of the benefits. Stoping tons per rig, how we've actually improved as well. Secondary support, de-stress, development. If you get all these things right and you get them in the right areas, the gold will come.